This is ICT's video notes on episode 6 and 7 in his 2022 mentorship. So, first thing we're going to go over is displacement high and displacement low. So we see we have three candles here, right? This is the fair value gap because the second one extended below the first and the third one extended below the second, but the high of the third did not touch the low of the first candle. So there's our fair value gap. And then we had our displacement because price moved aggressively below a low after taking out buy side liquidity. So we have a sell model here. And if I speed it up, you see price is heading up. So what you can do is when price takes out a high, you can mark up the move that caused it to move down as a displacement high, and the move that broke structure, you mark up the lowest point and mark it up displacement low. And between displacement high and low, you'll look for a fair value gap, preferably one that's very noticeable like this, and you will basically be using that to further help your daily bias analysis. This works on every time frame, but in this case we're using it on the daily for directional bias. So as you see here, price trades into it and you can sell down. You can sell from it, but we're using this as directional bias because this is a higher time frame. So what we will do is basically once price hits our fair value gap, we will be selling all the way until we hit this fair value gap or this low, and we'll be looking for sells every single day. Now we might get an up day and we might lose, and that's fine, but most of the time you'll be getting bearish days, so you should be fine. When price gives you a move like this, what you can do is grab your fib from the most energetic move up to the most lowest. So see, this has the most energetic move. See all of these sell candles, the most energetic move, right? You put the fib from highest to low, and you can basically anticipate that price will come up to around equilibrium or a little bit higher in a premium market. That way you know you can start looking for buys, and as you can see here, price starts to consolidate. And what you can do is another way of furthering your analysis for more higher probability trades. You can let's see, let's go back, sorry. You can I think I have it right here still. Nope, I don't. Okay, it should be here somewhere, February 2nd. So if we go to 15-minute time frame, we go to February 2nd. Where is it? 7? Okay, February 2nd. Around right here. We can see we have right here, we have buy side liquidity, so we can mark that up as buy side liquidity. And below right here we have sell side liquidity that got taken. Now here would be on a lower time frame, you can see it probably a lot better. Here we have relative equal highs, so this would be a target area. So we can put it as relative equal highs. Just leave it like that. So the sell side liquidity was taken here, and we can expect price to break a high, and we can look for buys. And you can see on this chart, you won't be able really to notice it. It's on a lower time frame, but I cannot go any lower due to the fact that I made this video late and this is very far in the past. So what you can do to further your confirmation, you'd basically look for the market shift model to happen in here. Here is how you can kind of determine whether your bias is correct. So like I said, we're consolidating at equilibrium, so we know that we're bullish pretty much. So when you have sell side liquidity or buy side liquidity get taken and you know you're waiting for a market shift model, you can use this called SMT divergence. You can see here as NAS 100 was making a lower low, so was the S&P 500, and then here is the Dow, which is the main currency. You see all of these are correlated pairs, but we're looking for a crack in correlation, and as you see here, we have a crack in correlation here and here. We are bullish. Remember, we're bullish. You never trade this by itself. We're bullish, so what we see here is that this low got taken, the south side liquidity, and so did this south side liquidity, but the Dow wants to move up, furthering or kind of analysis like opinion saying that we're bullish, and we are bullish. So what we know now is that price wants to go bullish, but these two have a crack in correlation. So we know that when they take out these lows, we can expect price to head high, so it can correlate once again with all these pairs. You see, all the pairs correlated after all. And so this would happen vice versa. Let's say buy stops were taken, you would look for two pairs to have buy stops, or maybe even just one, depending what pairs correlated. And if it goes with your bias, then even better. Like, I'm bullish. If we're bullish on this and we see prices heading lower but prices heading higher here, we know that we can look for the market shift model and look for a buy. Now let's say we don't have a buy opportunity, there's no fair value gap on the NAS 100. We can go to S&P 500, and if there is a buy opportunity or a fair value gap, we can wait for price to hit entry, but instead of buying here, we would buy on our first initial pair. And and we can target the high from the Dow right here, even though there's equal highs here. It's just better furthering or profit area. It's just kind of how would I say it? It's kind of reassuring us. And if you were to move price, if you were to get a fib from here to here, you can see that here's just above equilibrium, which is why we would target here mostly instead of here. And yeah, that's pretty much how it works. How we can further have confirmation that price will head in our direction. As for this, you see, we would basically be selling, here, and once price comes up here, consolidating, we know price might head a little bit higher from equilibrium. And that's pretty much it. And the reason for fair value gaps, by the way, is because price is efficient, which means it's 50% buying and selling. And when price is heading too much in one direction, it leaves gaps where price has to come to make price efficient again. And that's the reasoning for fair value gaps. Other than that, that concludes episode 6 and 7 of ICT's teachings. And yeah, hopefully that helps. And like I said, if on the 15-minute time frame there's no entry on your, or 5-minute time frame, there's no entry on the pair that you're looking at, but there is on another pair that's correlated, you can use that entry on the other pair for this pair, and you would pretty much target the same area on both pairs. And let's see, you would basically go on a lower time frame and look for the market shift. Like, does price break this high? Yes. Is there a fair value gap? You can't see it on this time frame, but possibly on a lower one. And the SMT divergence is just another confirmation. And I hope that helps. Let's see. Yeah. So that concludes the video note. So if you're bearish, you would look for highs to get taken, or you would look for highs to get ran, and then the correlated pair to make a lower low, and this to make a higher high. So it's pretty much vice versa. The pairs that take liquidity are pretty much the ones that you want to trade off of, and the ones that don't take liquidity are pretty much heading in the direction that you're initially anticipating, or is the pretty much the direction that you should be trading. So it's confirmation, and yeah, that's it.